Today, we're digging into one of the biggest stories in Indian aviation, IndiGo's massive strategic shift. We're talking about its evolution from a dominant low-cost carrier into a truly global network airline. We'll be looking at things as they stand in January 2026, which is a really fascinating point in time, full of headline shocks, but also some deep structural changes. So let's get right into the analysis.
The key to understanding IndiGo right now is being able to separate the noise from the signal. The noise, that's the recent disruption, a 78% drop in net profit that really grabbed all the headlines. But the signal, and this is the much more important long-term story, is a fundamental change in the airline's entire business model. Our goal here is to deconstruct that exact dynamic for you.
All right, here's how we're going to break this down. We've got 5 sections. We'll start with that recent shock to the system. Then we'll unpack the pivot to a global carrier. After that, we'll weigh the bull and the bear cases. And finally, we'll look at the defining crossroads IndiGo is facing right now.
Okay, let's dive into Section 1, a shock to the system. The market was definitely taken by surprise with IndiGo's Q3 FY26 results. But as you're about to see, the story is way more complex than just a simple profit collapse. Now, this slide is where the story really starts to unfold. The airline reported a net profit of 549.8 crore rupees. But look at how this waterfall chart builds the picture back up. You see, that number includes 2 huge one-time charges. First, we add back a 969 crore provision for new labor codes. That's a non-operational regulatory thing. Then, we add back the 577 crore rupee impact from what they called the December Meltdown. So once you strip out these exceptional items, the adjusted or normalized profit is actually closer to 2,100 crore rupees. This just perfectly shows the huge gap between a headline number and the real underlying health of the operations.
So what exactly was this December meltdown? Well, in late 2025, the regulator brought in new flight duty time limitation norms, or FTTL. These new rules, well, they kind of created a temporary paralysis in IndiGo's really complex crew management systems, and that led to a ton of cancellations. It was a massive stress test on their expanded scale, and it cost them 577 crore rupees. The key takeaway, though, is that this wasn't a broken business model. It wasn't a failure in demand. It was a one-time operational headache, and their scheduling algorithms have since been fixed. In fact, the airline's technical dispatch reliability is still a world-class 99.9%.
And all that brings us right to Section 2, the pivot to a global carrier. Now that we've filtered out the short-term noise, we can really focus on the long-term signal, and that is IndiGo's very deliberate move away from being just a pure low-cost carrier.
This S-curve is absolutely crucial for understanding the why behind this whole strategy. Look, IndiGo has already captured over 60% of the Indian domestic market. When you're that dominant, the room to grow organically just isn't there anymore. So to keep that growth story going, the airline has to pivot to the next cycle, international routes and that premium corporate segment. The goal is no longer just about owning the domestic market, it's about making India a global aviation hub.
The first piece of this pivot is IndiGoStretch, their brand new business class. They've started rolling it out on the really lucrative Delhi-Mumbai and Delhi-Bengaluru routes, and it's a direct shot at the corporate travel market that's been dominated by full-service airlines. The money side of it is just compelling. Domestic premium tickets historically sell for 2 to 3 times more than economy. So this move is a very clear, very calculated play for a big expansion in their margins. Of course, a strategy like this needs the right tools, the right hardware, and this slide shows you exactly that, IndiGo's fleet evolution. They built their domestic empire with the A320neo family. Now they're bringing in the A321XLR, which is a long-range narrowbody that can connect India to Europe and all the way to East Asia. And if you look ahead to 2027, the wide-body A350 will let them get into the ultra-long-haul game. All of this is backed by a mind-boggling order book of over 1,000 aircraft, which means IndiGo will keep one of the youngest and most fuel-efficient fleets in the entire world.
And this strategy isn't just on paper, it's already happening. The new Athens route, which they launched on January 23, 2026, is the perfect blueprint. By using that new, super-efficient A321XLR we just talked about, IndiGo can now profitably run 7 to 8 hour flights to Europe. These are routes that were just never economical for them before. This model, using a narrow body for long haul, is the key to unlocking their next big phase of international growth.
All right, now that we get the strategy, let's move to Section 3 and build the bull case, what we're calling Fortress India. What are the core strengths that really support this ambitious vision?
The foundation of the entire bull case is this right here, the Fortress balance sheet. IndiGo is sitting on a massive cash pile of over 51,600 crore rupees. This gives them 2 incredible advantages. First, it means they can pay for their huge fleet expansion themselves without taking on risky debt.
And second, it acts as a shock absorber, letting them survive things like oil price spikes or operational blips that would absolutely cripple smaller airlines.
The second pillar is the competitive market itself. The Indian market is basically consolidating into a duopoly between IndiGo and the newly energized Air India group. With over 60% market share, IndiGo's sheer scale creates a powerful defensive moat. This market structure makes irrational price wars less likely and really supports stable, long-term pricing power, especially on those key metro routes.
Now, for a balanced view, we have to look at the other side. So let's get into Section 4, the bear case. This ambitious transformation is definitely not without some pretty significant execution risks and structural challenges.
You can really group the risks into three buckets. First, you've got regulatory and labor costs. That recent 1,546 crore rupee hit proves that regulatory changes can wipe out margins in an instant. Second is a potential identity crisis. Shifting to a dual-class, long-haul model adds so many layers of complexity: food, crew training, loyalty programs that threaten the super-efficient, low-cost DNA that made them so successful in the first place. And finally, you always have macro factors. A weaker rupee against the dollar hits their lease and maintenance costs hard, and they're always going to be sensitive to oil prices.
So this brings us to our final section, the defining crossroads. IndiGo is really at a pivotal moment, and the next couple of years are going to be absolutely critical in shaping its future.
This roadmap highlights the key things to watch. In the short term, for Q4 of FY26, the guidance is for 10% capacity growth and getting operations stable again. Through FY27, a really key metric will be scaling up their 6E Rewards loyalty program toward 20 million members. And then the huge milestone is in 2027 when they bring in the Airbus A350 fleet. That marks their official entry into the big leagues of the ultra-long-haul market.
We'll end with this perspective, which is based on commentary from CEO Pieter Elbers. It really frames the whole situation perfectly. The recent operational pains and the profit shocks, they're being seen not as failures, but as necessary growing pains. So the central question for the market is this: can IndiGo actually manage this incredibly complex transition and become the global aviation giant it wants to be? The next 24 months will give us the answer.